Infraestructura. El día de hoy tenemos una magnífica presentación a cargo de Kris Johannsson. Ahora el profesor Fausto Hernández del CIDE hará una presentación apropiada de Kris. I'm going to switch into English, and I was saying just good morning to everyone, and I'll give the floor to Fausto Hernández Trillo, professor of CIDE, and also to Kris. Please, Johannsson. Fausto.
Well, good morning to everyone. Today, I have the honor to introduce Kris Johannsson. Kris leads on the development of capital stocks and national balance sheet estimates at the Office for National Statistics in the UK. Kris previously worked on increasing the granularity of multi-factor productivity estimates and has a BA in land economics from the University of Cambridge. Kris, welcome to this series of seminars. It's a pleasure to have you here. And as you may know already, you have up to 40 minutes for your presentation, and then we will have a time for questions and answers. The total scheduled time for our event, it's about an hour and a half, or up to 90 minutes. Well, the floor is yours, Kris, and thank you.
Okay, thank you very much for having me. Yeah, if you can let me know if you can see my slides. Can you see the slides?
Perfect, perfect.
Okay, brilliant. Okay. Okay, yeah. So, in terms of, I just go into a bit of background of what we published recently in terms of capital stocks. We published a user guide, and the purpose of the user guide is that previously we published sort of the methodology in terms of how we produce estimates of capital stocks, and the estimates then we derived from that methodology. But it could be difficult for users to really understand. It was a bit of a black box whether how were their estimates produced. So what we decided to do was to publish the inputs, so our estimates that we use to produce capital stock, so flows of investment and so forth, and also the code that used to generate it. So to give you an idea of why that might help users is, for example, in terms of the capital stock in the future is quite dependent on previous investment. So you could run the system and see, like, if you didn't invest any more in certain areas, what would the level of capital stock be in 10 years time? Or if you forecasted that investment to rise by certain amounts, what will that capital stock look like in the future? So that's one sort of advantage of being able to, with probably seeing the inputs and the coding that enables that users can sort of get an idea of, given different scenarios, what might the capital stock look like in future. And another benefit is you can also look at the parameters. If you made some different assumptions, what would capital stock look like? Okay, so to give you an overview of sort of, I'm just going to go through in terms of go through capital stock. Start with what is capital stock and why is it important. Then sort of go through what do we need to measure capital stock. So how do we get to our estimates of capital stock? And then at the end, I'm going to look at some of the challenges in identifying and measuring infrastructure within capital stocks estimates. So capital stocks measures the value of fixed assets. So I imagine most of you know what fixed assets, but just to clarify, fixed assets are produced assets, so they don't include things like non-produced assets like land that are used repeatedly or continuously in the production process. So if you've got a bit of machinery that isn't used for up to a year, then that's not included in capital estimates. It needs to last longer. Okay, so when we're talking about capital stocks, what does that include? So in terms of the UK, most of the sort of value of capital stocks are the sort of longer-lived assets. But by their nature, the fact that they live longer means that they tend to have sort of higher estimates of stock. So talking about dwellings, other building structures, and in terms of infrastructure, the other structures element of other building structures are probably going to be particularly important. So when you think about other structures, roads and railway networks and such like, you have things like machinery and equipment. You go down, and then weapon systems, biological resources. So that will include things like dairy cattle will last for quite a long time, so that they'll be included in that. And then you've got intellectual property products like research and development and computer software and databases. Okay, and in terms of there's a range of measurements that you can use to measure capital stock. So you can measure the capital stock as gross capital stock. So for example, if you have a newly built car, if you measure the gross stock, say we don't have any inflation, obviously an unrealistic assumption, but if we had a car that lasts 10 years and it was bought for £10,000, that would be worth £10,000 in 9 years' time, because we don't take into account any of the depreciation of that car. So often we'll want to know what the net capital stock is. So we want to calculate what is the value of that capital stock at that point in time. So we want to account for depreciation, the fact that car that's 9 years old, it won't be in the sort of condition that it was when it started its life. I'll go into the productive stock. So generally you want to look at the productive stocks often used in terms of looking at productivity measures. I'll go into that in a bit more detail later. And often one of the important parts to measure is the capital consumption, so the depreciation of capital in a given period. Okay, one question is, why is capital important? So this is from the OECD Measuring Capital Manual, and it gives you sort of a simple economy of producers and consumers. You can see that they've obviously got product markets and labour market, but obviously in this instance, we're interested in the capital market and stock and flow. So in terms of capital, there's two ways we can be interested in it. We're interested as a sort of a store of value. So in terms of it being, in terms of savings and capital income, and also on the producer's side, revenues from the sale of investment goods and investment goods, it's got a value in terms of storing wealth. You also have its value in the production process. So you see there's the capital services you get from it and the rental payment related to that. And obviously the amount of capital an economy has is going to be very important in terms of what output it can produce. So the next question is, okay, it's useful to measure, but what do you then need to produce estimates of capital stock? So ideally, you want a long time series of gross fixed capital formation. When we talk about gross fixed capital formation, it's very similar to investment. The only difference is that you have the transfer cost of some capital. So, for example, you might have legal costs in terms of buying a house. That's not investment, but that's counted in gross fixed capital formation. Generally, the estimates will be in current prices. So what you need to do in terms of to calculate estimates of capital stock, you need to convert them into a uniform price. You can't compare investment in, say, 2000 with investment now. So you'll need a long time series of deflators to go with that long time series of GFCF. And that sort of forms our first part. We need these long time series. The next bit we need to understand is how long are these investments going to remain used for. So if a company buys a car in sort of now, how long is it going to last for? So you'll need to make some assumptions about when it's going to be retired and also how it might lose value over time. And then that's where it comes applying the perpetual inventory method. So the perpetual inventory method is calculating how a investment depreciates and is retired, and what you then need to do is accumulate all that to accumulate all the past investment to produce estimates of capital stock. Okay, so in terms of we need a long time series, but how long a time series might you need? So this slide shows the sort of a map of the London sewers, and they were sort of a lot of the construction work started in sort of 1859, and they're still in use today. So it can show you that in order to capture the value of infrastructure, you can need a very long time series to ensure you capture all of the stock that's still present. So, for example, if you only had an investment series from, say, 1900, it means you might underestimate your capital stock because you've not captured all the investment that's still being used. In this example, we don't actually use estimates as far back as 1859. We have a maximum life length of 135. I don't know how much is the case, but it could be that although the original investment was made then, there's been so much additional work to extend the life of that asset that the original investment is no longer sort of remaining within the capital stock. Okay, so the next question is then, you need this long time series GFCF. What does that include? So in order to estimate GFCF, you need to take into account new assets, so anything newly built, and also major repairs and renovations that extend an asset life. So we're not talking about sort of regular repair and maintenance. You don't want to include that. In order to be counted as GFCF, they need to be quite significant either repairs or renovations that mean that, I don't know, if the asset was going to live for 20 years and I don't know, it's 10 years old, maybe you're carrying these major repairs and it can last for another 10 years. So in that case, you'd want to include that. In terms of producing estimates of GFCF, we use sort of a number of sources. So we have surveys that ask companies how much have you invested in various assets, and we also use administrative sources. So, for example, government investment data comes from administrative sources. Okay, so as I'm sure you can appreciate, producing deflators going far back is probably challenging in itself, but there are some sort of unique challenges in producing deflators for capital stock as opposed to other assets. One is that capital goods can be quite unique. So it could be that, I don't know, there's been a major new airport built. So you've got a new runway. So what value is that runway 5 years later? It can be that you don't really you can't observe what the price of a runway is. Maybe no one built a major runway in them 5 years. So there are challenges to sort of capturing that. You can assume that maybe the cost of constructing a runway is similar to a road. So there are ways around it, but there can be challenges in terms of the uniqueness of capital goods that mean that it can be challenging to observe price movements. Another challenge, although this probably relates to other areas, is capturing technological improvements. So if you're not capturing the technological improvements, you might, for example, see that, oh, it looks like our estimates of hardware have fallen, and that could be a problem with your deflator, is that it's not picking up improvements in technology, which means that it's probably not plausible that you're seeing that your hardware is worth less than it was 5 years ago. But if you are seeing things like that, that might indicate that there are some problems in terms of how you're comparing prices across time. Okay, so in terms of, let's say we've got this long time series of investment. So at the left of that is the investment, and in this case we're talking about it being in real terms. So we've applied the appropriate price indices. Then the next stage you can see is producing a retirement function in order to get the gross stock. So 5 years ago, we actually had a look at the asset lives we used. These were quite old. You can see some of them were last estimated in 1964. So we produced new estimates of these. So yeah, an important part of estimating the value of capital stock is to make sure that you've got appropriate estimates of the asset life. If you have the wrong incorrect estimates of asset lives, then that's going to affect the quality of your estimates of the amount of net capital, because you're depreciating things at the wrong rate, and you're allowing things in this case we used to have longer asset lives, so they were remaining. If the asset life was too long, the stock of capital is remaining in the economy long in your measure of the economy longer than it actually is being used in the economy itself. So an important part of measuring capital stock is having an appropriate assumption in terms of the asset life used. The next thing you need to think about is how is the retirement going to be distributed? So you could have a simple assumption that if your asset life is 10 years, that all investment was retired at the same time. It's not particularly realistic, though. It's likely that, I don't know, if you spent if in the economy, let's say £100 million in a period was spent on transport equipment, that some will be retired much shorter period than 10 years, maybe 6 years, but others will be used for longer than that. So you need to decide how you think things are going to be retired. I think we use a normal distribution for most of our assets. The next bit is how is it going to be, how close to the mean retirement age should assets be? Is it spread out, or is it quite concentrated around the mean? In addition to that, we do have some sort of limits in terms of what distribution that should be. So, for example, we don't allow any asset life to be less than 1 year, in keeping with if you remember that for it to be considered a capital good, it's got to last at least a year. So we don't allow anything to be retired within a year. And equally, we have some limits on the other end of the spectrum, that if we think it's past a certain age, then all the assets in that investment period should be retired. Okay. So when you've taken your estimates of investment in real terms, you've applied a retirement function, then you have an estimate of gross stock. Then you can look to produce estimates of net capital if you're looking at the top of the set of slides, or productive stock, and that's by either applying an age price and age efficiency function. Just to go through the intuition behind what these means. So a light bulb isn't considered capital, but it gives you a good idea of what we mean by age efficiency and age price. So in terms of a light bulb, you'd expect its efficiency is perfect until it's no longer usable. So in this example, it no longer works after 10 months. So what we're saying is it's perfectly efficient until there's no loss in efficiency until it no longer works. The age price profile measures the price effect. So no one's going to buy a 9-month-old light bulb for the same price they would a new light bulb, because although it's perfectly efficient, then they know it's not going to be perfectly efficient for very much longer. So the age price profile takes into account sort of the flow of future services you're going to get from this asset, and adjusts the efficiency for price. So if the light bulb had a drop in efficiency over time, you'd see that the age price would be lower than that straight line. Okay. So in terms of the age price and age efficiency profiles, you've got a number of ways of deciding how you think it's appropriate to depreciate the capital, and ultimately that will affect your net capital stock. So if you see in the top left, you've got a linear age efficiency profile. So what that means is it's losing value at a constant rate. So this has 8 years, but I'm going to use 10 years as an example, because it's a nice round number. So say you've got 100 million of investment, and say if its efficiency declines in a constant rate, say it lasts 10 years, then it'd lose 10 million a year, and then be worthless after 10 years. So the assumption around that is that things decline in efficiency in this case at a fairly constant rate in terms of value terms. The hyperbolic age efficiency assumes that things tend to lose value towards the end of its life, which is what we use. And quite in terms of some assets, it's especially things like buildings, it seems appropriate in terms of if you built a new building 20 years later, I mean, it's probably going to be quite efficient. It's going to keep the rain from falling on you and so forth. Probably quite well. There's probably very little difference in terms of maybe 20 years. There'll be some difference, but not a huge amount. And that most of the decline in its efficiency will happen probably towards the end of its asset life, where it will decline at a faster rate in terms of its efficiency. And then you see at the bottom you've got geometric, and under geometric, instead of declining in like a set amount a year, generally you'll see sort of a percentage decline. So, for example, 10% a year. You can see that the choice of profiles has a more pronounced effect on the efficiency of an asset. That what profile you choose has more effect on that, but it does have a significant effect on the age price profile as well, just not as pronounced. In terms of, we use hyperbolic, but that doesn't mean that because we apply hyperbolic rates that means the same for all assets. We have different rates between different assets to reflect that some are more weighted towards declining efficiency in the end of its life. You have a choice in terms of when you calculate capital stock, to sort of start from an age efficiency or age price profile, and generally the two concepts should be linked. So we calculate an age efficiency profile and then convert that using a discount rate to get to an age price profile. I won't go into details of that, but if you want to ask me any questions later on that, that's fine. Okay, so yeah, I was talking earlier in terms of what we've done is publish sort of our workings in essence, rather than just publish the estimates. We show how we got to these estimates. So in terms of the PIM model, the PIM, the model we use to calculate to sum all this investment, all the code is on GitHub. So that's the image on the bottom left. I think the slides will be shared, and there's a link to that on the presentation slides there. So that means that given our set of inputs, you can just run the set of code, and it'll tell you what the outputs are. So if you wanted to change a parameter in terms of you think you want to see what happens if you increase the asset life, you could see what effect that would have compared to the asset life that we think is appropriate. And on the right hand side, you see and you see what the data set looks like. So this shows you that we break assets down by sector, industry, and asset, and we do have some GFCF data going back to 1828. Obviously not all assets. We have quite that long estimates of investment. As you can see, there are quite a few empty cells there. You can only see a sort of some of them. This tab in particular is GFCF in current prices. We've got a number of other tabs that are needed to sort of produce the estimates. Okay, so a question following on from that is, okay, we've got an estimate of capital stocks, but how much of that relates to infrastructure? So I think that's a very significant problem in terms of often we won't measure things that produces nice breakdowns that you can easily identify that relates to infrastructure. That doesn't. We have industry and asset breakdowns, but that doesn't necessarily mean it neatly aligns. So you'd imagine, so in the energy sector, in the energy industry, that most of that probably is to do with infrastructure, but you'll also have, I don't know, head offices, and sort of maybe call centers in terms of dealing with billing. So it's not an you can't always identify exactly what is infrastructure and what is not. So the darker line here at the bottom shows what the net capital stock of other structures is. So you can see that seems quite a small proportion of the total, but obviously that although many of the things that you might want to measure is in terms of infrastructure, in terms of roads and railways, should be included in that estimate, there are other parts of the infrastructure that might not be picked up. So, for example, in the energy sector, there's probably important important equipment and machinery that you have, and they're not captured in that structures estimate. Okay, so another challenge in terms of measuring infrastructure within capital stock statistics is that economies change over time, and we're not always as fast as keeping up with what these changes are. So maybe sort of 30 years ago, if there was investment in energy, it would look fairly similar in terms of the asset life that it had. But this shows you that today, if depending on what's being invested in a particular time, can have an impact on what asset life you should be giving that investment. So if a country decides to invest, I don't know, heavily in renewable technologies such as wind and solar, if you're not capturing that it's wind and solar and it's just energy and we don't really know what it is, then it's got a lower life expectancy of sort of 20-25 years. If previous to that it was, I don't know, it was investing in hydropower and maybe improving distribution and transmission, these are a lot longer lived assets. So I think one of the challenges going forward is, can we make sure that when we're measuring investment, that we have the necessary level of detail to understand how long, what's being invested in, so we're making sure that we're depreciating it appropriately because of the differences in the asset life that it might have. Okay, so it's sort of in conclusion, in terms of we've published sort of the UK Capital Stocks Guide, and that's sort of a good step forward in terms of adding transparency, so our users can look at what might the net capital stock look like in 5-10 years time, and think about what future investment might look like, or spot any future problems. Does it look like that a lot of some sort of infrastructure is coming to the end of its life? So that's a improvement we've made, but there are many challenges we still have. So one of them is making sure that we're accurately measuring capital stock. As I'm sure you can appreciate, given sort of the nature of having long time series investment, and trying to capture the price movements of all this, and the fact that although you might have an estimate for other buildings and structures, that the other buildings and structures can contain many things, and with the energy example, that you might not be capturing the detail that you'd like to capture. So, for example, although we do produce estimates of other buildings and other structures, we don't capture the data at that level. We have to apply. We have done some research on how we allocate the other buildings and structures, but we don't get that from the source data. We have to work out from some responses in particular years what it looked like at a certain point in time, but there's no guarantee that it will continue to look like that going forward. So that's one of the challenges of breaking down what investment looks like, and are you treating it correctly. So one of the things we're doing at the moment is sort of having sort of a deep dive into energy and seeing what other sources can we sort of find. What does it look like if we try and break things down at a lower level? What will estimates look like then? Another piece of work we're doing is actually on the national balance sheet. So it was quite a long time ago since we reviewed how we measured sort of the combined value of land and the capital sitting on that land. So what we think is when we finished work on that might show that there might be some improvements we need to make in terms of, are we capturing the transfer of different buildings and structures between different industries and so forth. So that's another area that we're going to look to work on in the future. Okay, that's the end of my presentation. Thank you.
Well, thank you very much, Kris, for your excellent presentation. I think it was very useful for us. I do have a question before I open the floor. Yep. You said that we have to be very careful with deflators. Which deflator do you really use? I mean, I understand that it's very, very hard to capture the price of infrastructure and especially to capture price changes from one period to another. What do you use?
That's actually a very good question. So for infrastructure itself, I think I'd have to look in more detail. I know we have. I think I mentioned hardware and software issues that I know we do have, and we're looking to make improvements there. But I'd have to get back to you in terms of how we exactly produce the deflator estimates for infrastructure.
Correct. Thank you very much for this. I don't want to monopolize my intervention, so I will open the floor to other questions. Can you just please raise your hand or write it down in the chat of the meeting, please? Unless my Teams is failing, I don't see anyone. Well, here I have Ramiro Suarez. Please, can you just please introduce yourself and then place your question, Ramiro? Thank you for your question. Go ahead, Ramiro.
Hi, thank you. I'm Ramiro Suarez from Mexico Evalúa. This is a think tank in Mexico City, and I'm in the area of expenditure, public expenditure. So at the end, you mentioned that, well, you have increased the transparency of this data. So I would like to know if you are open to some kind of feedback from some organizations, so they can maybe suggest some improvements to this data, maybe to include some indicators. And if when you decided to open this data to make it more transparent, did you organize some kind of workshops to NGOs, to think tanks, to transfer this information, to communicate the benefits of this data? Those are my questions.
Okay, thanks. Yeah, so we only published this a few months ago. So in terms of we've not had many users look at changing the parameters and sort of asking questions around that. Mostly the use so far has been the UK Treasury in terms of looking at improving its forecast of capital consumption going into the future. So yeah, we've had some sort of webinars to explain that to them, but yeah, we've not at this time sort of spoken to sort of a more international audience in terms of its use. We have spoken to we have had some conversation with the OECD, but yeah, we've not had too much sort of. Well, obviously, we're open to people looking at using this to produce their own estimates or to see what that looks like, but we haven't had so much feedback on that at this time.
Perfect. Juan Carlos Moreno, please.
Hello, Fausto. Hello. Good morning or afternoon or night. I don't know with what's happening in the UK, my dear. I don't know whether it's good night or good whatever. Anyway, good luck, basically. Congratulations on your work, Kris. Very, very impressive. One thing I have like 4 questions. One is, once you start talking about efficiency, how do you deal with the environmental costs of different types of infrastructure? Have you thought, is that one of the challenges that you still have to face, or are you already making some progress on that? Because when you put out that list of different energy sources, or if it infrastructure or energy, well, one would say, well, one, I'd love to have that, and then one, I wouldn't even think that's an addition to capital stocks. Anyway, that's the first one. The second one is whether you be kind enough to, I mean, to help us like with a hitchhiker's guide to doing what you're doing now, because I mean the amount of work that you have done, and you and your team, obviously, I mean, it's impressive. How should we start in Mexico with all that that you do? I mean, obviously, I assume that we can copy your the routines, the computer routines, etc. That could be, I'm sure that your generosity would help a lot, but that's another point. And in the challenges that you didn't mention, are you thinking of dealing with like inclusion aspects of capital stock? Other of your colleagues in previous conferences have mentioned the importance of, well, having the capital stock and having access to capital stock efficiency, in the sense of perhaps social efficiency, not only economic efficiency, where you have a road that people can use or a park that people can use or can't use, etc. And finally, when you are measuring the value of capital stocks in a very open economy with changing exchange rates, how do you factor in? I know that Fausto already asked you about price deflators, but how do you introduce the exchange rates in that task? Thank you very much, and congratulations again. Land Economy does a great job in teaching students. Bye bye.
Thank you very much for those questions. So starting with, in terms of efficiency, we're just talking about the efficiency of that initial investment. So if it's £100 million worth of an asset, that it's still, in terms of if we just use its own price, it's still how efficient it is going forward. So yeah, I think one of the problems.
It's not replacement cost, Chris. Sorry to interrupt you. It's not the replacement cost; is the purchasing cost.
So in terms of what replacement cost in terms of gross stock or net stock?
Yes, no, well, no, in terms of buying a new machine that would do the same thing at a different price, I'm saying now.
So yeah, okay. So in terms of obviously then you've got deflators to convert that. But in terms of just thinking about so in terms of if I don't know if its sort of price has gone down 50%, it's just the efficiency would then be, it's 80% efficient of that, so you sort of produce them to sort of get that. But that sort of relates to that doesn't take into any account any environmental considerations. So I think that's one of the things we're seeing is that if you look at the multi-factor productivity of the energy industry, that if you account for labour and capital, it will tell you that in the UK we're getting worse. We're getting less efficient, but that's not we're getting less efficient. It's the fact that we don't take into account the environmental factors. And I think that's sort of a next step on, is that if we can sort of improve our capital estimates, can we also then identify from that or from a different source a way of taking into account that we're not that this story of we're getting worse at producing energy isn't correct. It's that we're not taking into account a very important factor. So yeah. That is something that we'd like to look to do in terms of producing estimates of capital stock, and we published all our code on GitHub. When I share the presentation, you'll be able to sort of go to it. It might be useful in terms of I do sort of in terms of there are instructions in terms of highlighting. I think there are some areas we'd like to improve, highlighting them, and sort of the importance of various things. So yeah, that might be useful to you. In terms of access to capital, I guess that's sort of a tricky question, and probably hard in terms of sort of measuring capital stock to address. So unfortunately, I haven't got a great answer for that. And sorry, what was your last question? I forgot that. Are you on mute?
Juan Carlos.
It touched on the subject of exchange rates, but anyway, I suppose it's also with price inflators, and that's it.
Yeah, so that should be captured. That hopefully should be captured in our estimates of prices. So, for example, if you're talking about things like hardware that we mainly import from other countries, the price indices team should pick that up. But I don't. At the moment, I'll only sort of look into price indices if I notice there's a problem and something looks weird. Given that given that we sort of get delivered these, that unless there's something that looks odd, I'm not sort of directly involved in that process, so I couldn't really comment that much more on that.
Thank you very much. Part of my question was, Kris, how would you start? I mean, if you were a Mexican, in that sense, I mean, we're still with.
Eso causa honorarios.
That's a very good question. I guess the starting point is, can you sort of find the data sources that you need for investment? Can you? I guess that's sort of the big starting point. What sort of data sources do you have to then look to produce these estimates? Yeah, we ask in terms of GFCF. We have surveys in terms of finding out what businesses invest in, and sort of for government and for other things as well. So we use administrative sources to sort of produce the estimates of GFCF to estimate capital stock.
Thank you very much.
Thank you for the questions.
We have a question. Carla Rojas, thank you for your question, Carla, and nice to see you here electronically at least. Carla says, how do you establish the categories of infrastructure? Would you like to place it, Carla, please?
Yeah, sure. Thank you. Nice to see you too. Okay, the question would be, thank you very much. How do you establish the categories of infrastructure, the specific economical activities and the related infrastructure? The question is because I want to know if you include vehicles or machines in the quantifications, because this is a problem that we are trying to resolve here. Thank you.
So yeah, I think in terms of the infrastructure estimates that are produced, that generally, I think I'd have to sort of check that this is the case, but I think generally we use other structures as a proxy, and I think I sort of mentioned that it's probably not a perfect proxy, so you should be including other things. And so I think this is an area that we probably sort of need to look at ourselves in terms of how do you identify these. I think I sort of touched upon the problem is that we know we've got this sort of stock estimate for total capital stock. How do you then work out what should be assigned to infrastructure and what shouldn't be? And I think that's a question that we need to answer ourselves. It's not just you.
All of us. Thank you very much.
Thank you.
Thank you for your question, Carla. We have a question. Jose Teran, please, can you introduce yourself and then place your question?
Thank you very much. My question is from one of my colleagues in the input-output division. I'm the head of input-output division. But we are actually collecting the assets for provinces in the base years. So the question are related to the sources of information. What kind of surveys or sources of information do you use to get the life expectancy of the assets? The second question is, can you share with us the survey questionnaires? And the third, if it is not by survey, are you only using administrative records? Thank you very much.
Thank you, Jose.
Okay, yep. So asset lives, I think as I mentioned before, 5 years ago, we looked at these. There's a variety of sources that we got. So for buildings, we looked for information from those sort of in the construction industry in terms of what their expected asset lives were for various buildings and so forth. For vehicles, it was sort of administrative data in terms of when the cars were registered in the first place, and when it was declared off the road, because when a car is no longer on the road, you have to declare it. So we looked at that. Another example was sometimes we use industry estimates. So for aircraft, we looked at I think company accounts. So there's a variety of sources that we used. There is an article that I can on our website that I can provide a link to. I'll probably add it to my slides before sending them round. So because I can't cover all of them in a short time anyway. In terms of capturing data, in terms of surveys, we use a quarterly capital acquisition survey in terms of capturing investment by businesses, and you can on the internet find an example of the survey questions. So yeah, that is available. It depends on what we think the best sort of data source we have. So for a lot of things we do use that, but for government it's administrative sources. So government departments record what assets they're investing in. So we have good information on that and various things. So for example, I think although we do ask questions on transport equipment, in terms of aircraft, we look, because we look at sort of imports to help calculate the value of GFCF in terms of aircraft. So there are a variety of sources. Hopefully that's given you a bit of a flavour of what they look like.
Thank you.
Is that okay, Jose? Or
Yes,
would you
okay.
like to add something?
Oh, that's okay. Thank you very much.
Thank you, Jose, for your question. Well, I don't see any other question, any other hand. I might ask you something. You said that well, perhaps I'm very rusty right now. You can check on my gray hair and my double chin. But as far as I know, the perpetual inventory method assumed a straight line depreciation, and you said you have different like methodologies like hyperbolic depreciation and things like that. So you have different depreciations for methods of depreciations for different infrastructures or what? And recall, I'm not sure whether I'm wrong or not, but the perpetual inventory assume straight line depreciation.
So I think traditionally most countries use a straight line method. I think a lot of countries have sort of moved away from that. So I think we sort of, a lot of the sort of Anglosphere, sort of Australia, the US moved to the hyperbolic method before us. So we sort of followed them in that. So yeah, so although it's traditionally used, you can use different methods of depreciation.
Do you have a manual for that or not, or? So
our estimates sort of come from the US. So we sort of borrowed that.
So they might have it in their page.
Yeah, they might have more detail in terms of sort of the research that went into producing them. For all infrastructure, we use sort of the same assumption. It's a hyperbolic, and the parameter we use is sort of 0.75. So yeah, that means that it's weighted more towards losing efficiency at the end of its life, which compares for like, I don't know, transport equipment, which we think that is not weighted toward the end of its life in the same way.
Okay. Is there any other question? Otherwise, yes, Juan Carlos has an extra question.
I don't know if it's excellent or not, but thank you again. Kris, you mentioned very quickly that not all capital stock is infrastructure, but I don't think that you examined the issue of what capital stock should be thought of as infrastructure as such. And the second question is, to what extent all the methodology that you presented us and you shared with us is consistent with the OECD or not?
So yeah, we use the OECD measuring capital manual as sort of the basis of how we measure it. There are some, I think, if there are some areas where we can improve sort of the measurement. I think that we need to I think there's just some small differences but generally we're in line with the OECD measuring capital manual. And in terms of capital stock, what's infrastructure? I think there is quite an open question on what is infrastructure, but I'd say you probably think a lot of capital stock would maybe not be considered infrastructure. I think generally dwellings might. That's quite a lot of the capital stock, and I think most people wouldn't consider that infrastructure. And things like supermarkets. I think when I think of infrastructure, whether that's correct or not, I'm thinking more of roads, railways, energy infrastructure, telecommunications, and things like that.
Did you include weapons?
I don't think we include weapons in infrastructure.
Okay, because I saw that list on depreciation. I didn't know whether that was included in infrastructure. That would be quite shocking, I assume.
Yeah.
So no, I was sorry, I was just going through capital stock of which a proportion is infrastructure. Thanks.
We have a question from Elio. Elio, would you like to place it, or you would like me to do it for you? Well, let me place it, Kris. Elio from the Data Science Lab at INEGI asked the following: Have you considered alternative data sources like satellite imagery or web scrapping of prices as an auxiliary input for your measurement over buildings?
Yeah, I don't think it's something that we've really considered. I think the problem with satellite images might tell you that I don't know, that you've got increases in maybe buildings or roads, but you then have the difficult question of how much did that cost. So potentially you could use it, but you'd need to have a good idea of how would you map the change in sort of what the satellite images look like with the cost of what that was worth.
Okay. By the way, perhaps this is not the right question for you. I don't know if you can answer this for me, but do you consider now, like retaking Juan Carlos Moreno's question is, do you consider military infrastructure in your estimations?
So we capture sort of investment in various assets in our estimates.
Okay.
But I didn't specialize in infrastructure, so I don't know if it's considered, but I imagine it's not.
Yeah, I know.
Most of it's not considered. Yeah.
I know. Anyway, I was just expecting someone else had another question, but I don't see any. So Ricardo, thank you very much, Kris. I think my moderation ends up here, and I appreciate your presentation, Ricardo.
Yes. Yes. Well, thank you very much, Kris. This is wonderful, and I think that it's hope it's a starting of a long cooperation with you, because we are just starting this kind of research here in Mexico. We're doing a work to try to our infrastructure. So thank you very much, and I hope we can follow on some of the things that you already said. Para todos, we're going to have a new conference on October 21, which is on water infrastructure. It's from Ismael Aguilar Barajas, which is a professor from Tec de Monterrey. So we hope you can join us on this next conversation on Mexican infrastructure. It's kind of just first start on what is this infrastructure on water. So thank you very much to you all, and muchas gracias a todos por conectarse. Tendremos una nueva conferencia el día 21 de octubre a cargo del doctor Ismael Aguilar Barajas del TEC de Monterrey sobre infraestructura hídrica. Entonces comenzaremos ahí vislumbrar un poco acerca de la infraestructura en México. Muchas gracias. Thank you for coming and good day.
Thank you. Bye.
Thank you.